right, since we have defined the internal controls and also the seriousness of a financial fraud, so now let's study how to control our cash, the most important assets in business. So the effective way to control cash is to meet the three basic guidelines. First of all, you need to make sure the person who handles the cash, who take care of the cash in and cash out, is separate from a record keeping. So that basically eliminates the possibility of producing false information. So if the record is separate, then the cash has to meet the record. Then basically the people who handle the cash have no way to embezzle or take away cash home. And also if cash is dispersed, and make sure it's made by check. So if it's a written in check or electronic payments like a WeChat or Zeller, there is always a record being kept. And also if you receive cash, and make sure the cash is promptly deposited in a bank. All right, just don't leave the cash everywhere on the floor, in the drawer, on the table. Okay, so the cash and cash equivalents, first of all, not everything is in a currency, coins, and also the saving accounts or checking accounts. Some of the cash could be counted as short-term investments. These investments are readily convertible to the cash amount, and also it's close to maturity, usually within a 3-month period. So in your cash account, it does not only include cash, but also the short-term investments, and we call them cash equivalents. So for cash management, so there are two goals. First is to plan cash receipts to meet the cash payments, and also keep the minimum level of cash as a cushion for unexpected event. And also you need to be effective at doing the management work. So you need to encourage collection of the receivables. If somebody owe you money, you want to collect it as soon as possible, and don't let them owe you for too long. And also, if you have liabilities, you probably want to delay the payments, so you don't want to pay too early. And also, you need to keep only the necessary assets. Don't use redundant assets. And when you do a large spending, we call it expenditure. Make sure you have a sound plan before that. And if you have excess cash that you have nowhere to put use of, you invest. Okay, you invest. And then this picture is showing you how cash is received by the company. So you have the clerks written up the cash on register. So these are your sales departments. So the cash will go there, and the revenue will be recognized. And also this cash will transfer from a sales department to the cashier's department, right? And you will see all the cash sheets are being recorded right here. So that's where you do these journal entries and put everything in the general ledger, and then process the data to present the data. So in this whole procedure, none of the people involved can take a mistake or divert cash without the difference being revealed. All right, so this procedure is very mature, that eliminates the opportunity for fraud. So just in case some people make errors and some people make mistakes, so this is necessary that we establish an account called cash over and short to record the difference of the sales you actually make and the cash you actually receive, right? So that basically is an account for errors and mistakes. So right here, when you make $550 sales, however, the cash you get is $555. So congratulations, you get a $5 cash from nowhere. If that's the case, you do not put it in your pocket. Actually, you have to put it in this account called a cash over and short. That's a credit. So this is like a revenue you earned from your mistake. All right, and this time you have a sales of 225, but your cash on the book is only 621. So you have $4 in short. It's like the mistake cost you $4. So that is like an expense. So it's put it as a debit, just as your cash, as a debit. All right, so the cash will be received by mail with enough electronic or paper evidence. So there's no way we can mess up with the amount with the cash. So here are some procedures. There you need to know there are people assigned for opening the mail. So usually 2 people taking care of the mail, and then the cashier deposits the money in the bank, and also the record keeper, which is a separate person, records the amount received in the accounting records. So here are the vouchers you will receive from your business, and you will have a cashier's voucher who sent the amount. You also have a accounting, receiving, supplying, and all this. So this is not going to be tested, just to give you an idea how the vouchers are organized based on different accounts, and also divided into the senders and the receivers. So now we have another control system. It's called a petty cash system of control. And we, as a business, have a lot of spendings that are at very tiny amount, like postage you buy for stamps to mail things, and also courier fees, repairs, and supplies. This cost does not add up to a large amount. So these are all small payments. And then we establish a petty cash just to take care of those small amount of spending. So right here, you will deduct $75 cash from your general cash account, and then you put $75 in your petty cash account. So this petty cash account is the account from where you draw money to pay all the small bills. So right here, we have this company called Z-Mart again, and it has miscellaneous expenses like title cleaning and transportation and some packages. So each of them is under $50, and they all add up to only $71. So if that's the case, you need to prepare a journal entry. So you will see these expenses added together. So those will be a debit, and you will credit your cash just because you have $71, and so that's going to be a credit. That's a decrease of your assets, and then you need to reimburse the petty cash. Remember, this is about petty cash. So basically, your cash drops first because of all these expenses, and then you will get the money from a petty cash to recover the spending from your cash. All right, so you can increase or decrease the petty cash fund. So basically, once again, when something, no matter how small is spent, you always charge your cash first, and then use petty cash to reimburse that. And then sometimes the petty cash is low, sometimes the petty cash is high. You can always withdraw money from the petty cash to the general cash account, or you can just do the opposite. You withdraw cash and to increase your petty cash. So if a cash over and a cash short, then of course those would be due to human errors. So if it is a debit, that means it's cash short. That's like an expense. And if the cash over is like a revenue, so it will be a credit.